What if I told you that the way most people think about risk is actually working against them? They avoid it, fear it, or ignore it entirely. And all three of those responses tend to lead to the same place: poor decisions made without a clear understanding of what they were actually dealing with. Before we get into it, what you're seeing is an AI generated avatar. The ideas, the research, the perspective, all real. We just think this is a pretty cool way to bring it to you. I'm John, and today on Beyond the Ticker, we are going to talk about what risk actually is, because it is not what most people think. The word risk gets used constantly in investing. Your advisor talks about your risk tolerance. Financial media warns about risky markets. Products are marketed as low risk or high risk, but rarely does anyone stop and ask, what does that word actually mean? Because risk is not one thing. It is several very different things that often get collapsed into a single word, and that confusion leads investors to make decisions that do not actually match their situation. Let's break it down. The first and most commonly discussed form of risk is volatility. Volatility is the day-to-day, month-to-month fluctuation in the value of an investment. Markets go up, markets go down, sometimes dramatically. Volatility is what most people picture when they hear the word risk: a portfolio that swings in value and causes stress along the way. But here's something worth understanding. Volatility is not the same as loss. A portfolio that drops 20% and fully recovers has experienced significant volatility. It has not experienced permanent loss. Treating volatility as the enemy often leads investors to make changes at exactly the wrong moment, selling during a decline and locking in a loss that the market would likely have recovered from. The second form of risk is permanent loss of capital. This is a fundamentally different problem. Permanent loss occurs when an investment loses value and does not recover. A company that goes bankrupt, a sector that becomes obsolete, or a decision made at the wrong time that cannot be undone. This is the risk that actually destroys wealth. And ironically, many of the decisions investors make to avoid volatility, moving to cash, selling during downturns, abandoning long-term positions, can create permanent loss where there would otherwise have been none. The third form of risk is one that almost never gets mentioned in the same conversation: the risk of doing nothing. Keeping money in cash feels safe. It feels responsible. But cash loses purchasing power over time. Inflation quietly erodes what a dollar can buy year after year. An investor who avoids markets entirely to escape volatility may find years later that their money has less real value than when they started. Inaction carries risk just as surely as action does. It is simply a quieter, slower kind of damage. There is also a fourth dimension of risk that is deeply personal and often overlooked: timing risk. The same investment can produce very different outcomes depending on when you enter, when you exit, and when you need the money. A portfolio that performs well over 20 years may still devastate an investor who needs to withdraw during a downturn. Risk does not exist in isolation from your life. It exists in the context of your goals, your timeline, and your circumstances. So what does this mean practically? It means that when someone asks how much risk you are willing to take, the honest answer requires understanding which kind of risk you are actually talking about. Volatility tolerance is not the same as the ability to absorb permanent loss. Avoiding one form of risk often increases exposure to another. A complete picture of risk is not just about how much your portfolio might fall. It is about understanding what kinds of uncertainty you are actually taking on and whether your plan accounts for all of them. This is a conversation we are going to keep building on this channel. Because once you understand that risk is not a single dial you simply turn up or down, the way you think about building a portfolio changes entirely. Beyond the Ticker exists to be a resource you can trust. Subscribe, like this video, and if someone in your life could use this, send it their way. We are grateful for everyone who has found us. See you next time.